One of the very famous hedge fund managers based in the United States was asked this question in an interview. Are you a bull? He said, yes. The next question she asked is, are you a bear? He replied, yes. Then she was flummoxed. The anchor was flummoxed and confused as to what is it that he was trying to say. So he clarified by saying, I am an opportunist. I am both a bull and a bear, but most importantly, I'm an opportunist. Hi everybody, I'm your learning partner Sushila Hariharan and I talk about global markets in different asset classes including equities, bonds and especially currencies. If you're interested in knowing more about such products, do subscribe to my YouTube channel because we provide data-centric, research-focused videos on these topics. To give you an example, every video of mine, which lasts for about 10 to 11 minutes, has behind it at least 4 hours of reading, other content, books, and data around with it. And that's how we come up with videos where we explain in a simplistic manner about topics that are related to us. So, what do hedge funds do? Hedge funds literally are pool of funds. What is the meaning of a pool of funds? A pool of funds is a concept wherein capital is collected from different investors and it is pooled in together, yeah, and this pool of funds is then invested in different asset classes. So hedge funds literally are pooled capital which are then invested in different asset classes depending on what? Depending on the investment objective of the hedge fund. So how do you go about starting a hedge fund? I don't know that, but I'll just explain to you a little bit about the concept of how hedge funds came into existence and why they are playing such a significant role and how they control so much assets in the world. Literally, the largest hedge funds in the world today have almost 3 to 3.5 trillion dollars worth of assets under management, and that's not a small number. Okay, so when a fund is formed, it starts off with the concept of a general partner and a limited partner. The general partner is the acting entity, and the general partner is the one that gets together capital from all the limited partners and puts in their own capital and creates a fund. Okay, you have onshore funds, you have offshore funds depending upon tax jurisdictions of different countries, and the fund that is formed then is in an investment mode. Okay, so the fund structure, the fund economics, the fund mechanism, legal entity, etc., is another video will be explained how that is important and relevant to the returns for the LPs. At this point of time, we'll say that the general partner goes on a pitch drive, puts up a pitch book, takes on investors, collects capital, gets capital commitment, gets capital into the fund, pools in this fund, and the fund then starts investing. Where do they invest? This depends upon the investing strategy of the fund, which has to be mentioned in the pitch book very, very clearly, or else investors who do not like that concept may not want to invest in that fund. For example, a macro hedge fund. A macro hedge fund is one that invests in the macro economics of any country. So they find a country is on the growth phase, the GDP numbers are looking good, inflation is benign, interest rates are benign. They are then willing to they're willing to then invest in that country. So such macro hedge funds also play in different asset classes in that country. Then you have hedge funds that are distressed assets hedge funds. What do? They buy out distressed assets. What are distressed assets? Distressed assets are assets which are not giving any returns to the investor. So that's a distressed asset fund. So they have multiple convertible arbitrage funds. These are the funds that invest only in instances of bonds which are convertible and which have an arbitrage opportunity closer towards redemption. So we have a whole plethora of hedge funds and they will clearly state what they're going to do. Most hedge funds are macro hedge funds. They invest in different assets within a country. They invest in different countries. They invest in different currencies as well. So they take on not just market risk, they also take on currency risk, market risk in terms of asset price movement as well as currency movement. So these are the hedge funds that are a pool of capital that is then invested by limited partners. Limited partners have to be accredited investors. Only accredited investors who have net worths upwards of $2 million are permitted to invest in hedge funds, because hedge funds normally take short-term, high-risk bets in different stock markets or different bond markets. Are they gamblers? No. Are they speculators? Sure. Big difference between the two of them. Okay, another video for the difference between gambling and speculation. So hedge funds then, because the GP, the general partner, charges, because the general partner manages the entire show, literally from getting in the partners, getting in the accredited investors, pulling in the capital, investing that pooled capital into different funds. On that basis, the fund manager then charges the partners, the limited partners, what is called as management fee. Management fee is a fixed percentage, normally between 1.5% to 2% of the assets under management of each of the investors. This is normally an annual charge and generally covers the administration and running around of expenses, including salaries to the fund and so on and so forth, to the fund executives and so on and so forth. What brings the frosting on the cake is the performance fee. The performance fee is a fee that the fund manager can charge when they outperform the underlying benchmark. Now, over here, the performance fee can go up to 20% of outperformance. Okay, so why management fee is mandatory, annual, 2% of assets under management. Performance fee is not mandatory, only if they outperform. Is it annual? No. When they outperform, they can charge a performance fee. And third is it's charged as a percentage of the outperformance. So then limited partners are also a little, they want to protect their interests, and therefore they will put in certain qualifications on which basis performance fees can be charged. For example, there's something called as a hurdle rate. So if the hurdle rate is 7% and the fund has performed, let's say, 10% year on year, then the fund manager can charge on the difference on the outperformance between the hurdle rate and the actual performance. Then in a block of 5 years or block of 7 years, the highest performance of the fund is called as a high water mark. If the fund hits that high water mark, the fund can charge very high performance fees. But next year, they will not be able to charge that kind of high performance fees unless they go above the previous year's high water mark. Okay, so high water mark, HWM, is a very important concept in calculation of performance fees in hedge funds, and this is where the mullah is, the frosting on the cake, as they call it. It is not annual, it is not mandatory, and most certainly it is a very, very high prestigious amount, because that's when fund managers get all their bonuses and distribution of bonuses amongst all the members of the fund as well. When does a fund wind up? It need not be the fund need not wind up unless it's a close-ended fund. It can be an open-ended fund, and accredited investors, after a lock-in period, can take away their investments from the fund. Some funds have been in existence for more than 3 decades, especially those of BlackRock, which have been in existence for some of the older funds, especially those that are in 1980s, 1990s. Those funds that have been there for a long time, so they don't actually close the fund unless they have been either made super duper profits, and they say, okay, this is it, we're done, we're not taking in any more capital, or they made super duper losses and limited partners want to withdraw all the capital, and they say, okay, let's wind up the fund. So till that point of time, the fund just stays in existence, and therefore most of the time we find hedge funds are open-ended funds. Do they create such a ruckus as I make it out to be? Yeah, they're very significant players in most of the economies, most of the countries. Look, a single fund is having like 1.5, $2 trillion assets under management. So obviously they are going to be in a position to play in a very significant role in different markets, and they do that. They actually do that, and hence it's very important to keep hedge funds. They play a very significant role in market movement and market prices. There have been a lot of noise about has the hedge fund sell off in India caused the stock markets to crash, etc. That is a discussion that is raging on in social media and across. But hedge funds do have a lot of capital invested in different countries, and thus they have the ability to influence prices in those countries. Thank you so much for watching it.